Hello, this is Ryan Mahoney at Cypress Asset Management, back once again for our quarterly review, Q4 2022. In this brief video, we will discuss global capital market performance across the various asset classes, looking at the returns of equities and bonds in both the U.S. and international markets. So let's begin. Viewed in isolation, it was a great quarter for just about every asset class that we track, with developed international equities leading the pack, reporting a sizable 16% return. Both U.S. and global bond markets were also up slightly for the quarter. So it was a very welcoming rally to wrap up the year, especially when we zoom out to look at returns for the 1 year. As the downward arrows can only indicate, 2022 was a trying one for investors of all major asset classes. We witnessed steep declines in U.S. equities, especially among growth stocks following their meteoric rise during 2020 and 2021. But developed international and emerging market equities were also down sharply for the year, as were bonds. The picture isn't nearly as grim when we zoom out a bit further to 5-year and 10-year returns. And we'll note the extraordinary performance of U.S. equities in particular during these two time horizons, as well as the relatively muted returns posted by the global ex-U.S. indices. Moving on now to notable headlines that marked the quarter. Plotted beneath the MSCI All-Country World Index, which tracks nearly 3,000 large and mid-cap stocks in 48 developed and emerging market countries. No doubt there were some investors of various bearish or bullish outlooks who acted on such headlines, though as we review them in hindsight, their relevance to global market performance appears negligible. Nonetheless, you might find this slide helpful if you tend to find yourself stirred, either positively or negatively, by the daily headlines from financial media. In the rear view, these headlines read as mere noise, intended not to inform and guide so much as to titillate and draw your attention. And here we see the same index charted across 2022, and the effect is much the same. Sundry headlines connected to but not determinant of global market performance. Now let's take a closer look at each major asset class's performance for the quarter. We begin here with U.S. equities. As mentioned before, U.S. stocks posted positive returns but underperformed both non-U.S. developed and emerging markets. And we see a U.S. value outpacing U.S. growth, and really not much of a rally at all for large growth, posting just over a 2% return for the quarter, compared to almost 12.5% for large value. It was a very tough year overall for large growth, down 29%, though not that surprising considering the preceding massive bull run that large growth enjoyed during the previous 10 years. Next, we have international developed stocks. Here again, we see positive returns for the quarter from both value and growth, large and small. As with U.S. equities, we see international value outperforming growth for the quarter and for the 1 year. Falling in between the returns of U.S. equities and developed international equities for the quarter, we have emerging market equities. Here again, we see value outperforming growth. You'll note the block of red there that predominates the 1 year, 3 year, and 5 year columns for this sector. It's been a very tough 5-year period for this sector, though as the accompanying pie chart indicates, the market capitalization for emerging markets is a mere 11% of global market cap. Thus, the sector's impact on the global market is decidedly small. Contrast this with U.S. equities, which comprise approximately 60% of global market capitalization. Here we see the 48-country component indices from the same MSCI All-Country World Index as referenced on the previous slides. And we see a very strong quarter for much of the world, barring a few Middle Eastern nations. Like U.S. and global equities, REITs, both U.S. and global, posted positive returns for the quarter, but negative returns for the 1 year. REITs, like emerging market equities, have faced a tough 5-year period, especially outside of the U.S. Now, how about commodities for the quarter? 2.2% according to the Bloomberg Commodity Total Return Index. Now we'll note that while commodities as an asset class do not play any significant role in the portfolios that we manage for our clients, or REITs for that matter, we nonetheless deem their performance as noteworthy as they provide further testimony to the overall randomness of returns that we so often touch upon in these videos and elsewhere. The period returns for commodities is about as random can get. We see a modest fourth quarter followed by very strong returns in the 1 and 3 year periods, but look at the 10-year annualized returns, down over 1%. Now keep in mind, this is during the same 10-year period when U.S. equities posted incredible returns. But the fact of the matter is that if we as individual investors attempt to concentrate our assets in not merely a handful of stocks, but even in a single asset class like commodities, for example, and here I'm reminded of those gold bug types that are forever bullish on precious metals. Well, these types have missed out on historic returns due to their over-concentration in a specific asset class. But that's not to say that commodities or REITs or what have you won't have a great run going forward. No, they very well could. But how can we predict this with any precision? Quite frankly, we cannot, and so it is better, far better in fact, to try and diversify as best we can, so as to grant ourselves exposure to numerous asset classes, while dampening our risk against over-concentration in a struggling one like commodities, for example. Now, I like to think that by diversifying globally, one is making a bet on humanity as a whole, that by seeking to capture something like a global market return in one's personal portfolio, the individual investor firmly believes in our collective ability to collaborate and innovate across races and borders for the net benefit of all. How else does a globally diversified portfolio net any returns or make any sense if we, as a global community, are no longer striving to improve ourselves, our families, and our nations? A bit of a digression, but we will wrap things up now by reviewing fixed income performance for the quarter, beginning with the U.S. fixed income. Interest rate changes were mixed in the U.S. Treasury market for the quarter. We saw significant yield increases on the short end of the yield curve, most notably with the 1-month T-bill increasing to over 4%, up 133 basis points for the quarter, while yields on the 5-year Treasury note decreased 7 basis points. We'll note that the yield curve is still, in fact, inverted, meaning long-term interest rates are currently lower than short-term rates. Now, practically speaking, this means that investors on the whole are predicting a weakening economy and subsequent intervention from the Federal Reserve via a lowering of interest rates. Hence the demand for longer-term bonds to lock in a fixed interest rate that is potentially higher than those of newer issued bonds in the wake of possible action from the Fed. This increased demand, of course, pushes down the rates on these longer-term bonds, resulting in the aforementioned inverted yield curve. But let's be clear here. Just as we can't predict which asset class or market sector might outperform in a given period, we can't, as retail investors, predict future action from the Fed either. Now, while it's certainly possible the Fed might reverse course in the near future, nobody knows when this change will, of course, occur. In the meantime, the Fed might continue with their monetary tightening, which would benefit holders of short-term bonds. So which is the best course of action for fixed income investors? Ultimately, it depends on one's goals. We at Cypress prefer to keep our fixed income ladders relatively short for our clients in an attempt to strike a sort of golden mean. Since the Federal Reserve has proven it does indeed have the resolve to raise rates significantly in order to fight inflation, we think it wise to assume they might continue with their tightening or at least maintain higher rates indefinitely. And since we focus on seeking returns not in our fixed income but in equities, we prefer to limit risk as much as possible on the fixed income side of things. And this translates into a preference, at least in this monetary environment, for shorter-term bonds. Now, might the current holders of 20 and 30-year treasuries be rewarded for their fixed income strategies? It is certainly possible. But it's just as possible that the Fed will undermine their expectations, in which case they will suffer the financial consequence. And in that portion of their portfolio, that should be a buttress against uncertainty, no less. We conclude with global fixed income performance. And here we see a similar picture as with U.S. fixed income. Overall, some increase at the short end of the curve and the reverse at the longer end. And with that, we'd like to thank you for tuning in, as always, to our quarterly review. We hope you're finding these videos both helpful and informative. Here's to a great year in 2023. Until then, we will see you next quarter.